Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. It's Thursday. It's the 3rd of November. My name is Russell. I'm a Senior Market Specialist, and my email address is r@fxcm.com. Just want to double check, can you guys hear me, and can you see the screen? Just let me know. Okay, excellent. Awesome. All right, let's bring up the market commentaries disclaimer. Keep this on screen for a few moments. Here's our references: MarketScope, TradingView, Bloomberg, specifically the email 5 things to start your day, and Forex Factory. Let's go to Forex Factory first. We've got the BOE announcement at 2 p.m. ZA, so that's 12 p.m. UK. Okay, so be aware of that. There's been a shift in the time because of the time change. So now there's 2 hours difference. 2 p.m. ZA, 12 p.m. UK. I want to bring up this chart, which is of course our real rate and our dollar. We'll come back to it in a moment. I think it's worth going through the Bloomberg note. So the first headline, higher peak. Fed Chairman Jerome Powell left little doubt that he's prepared to push rates as high as needed to stamp out inflation, even as the central bank eyes a downshift to a slower pace of increases. In a press conference yesterday, after the Fed raised by 75 basis points, and that was for the 4th time in a row, Powell said incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. What's he saying? They're saying the terminal rate is going to be higher. So the median sort of dot plot for the last was 4.6%. Okay, so we're probably looking high. Let's say it's shifted up to 5% now, but you know that's in flux, as depending on the data, right? His remarks shift the focus away from the size of the next rate hike to where they will peak and how long they will stay at those levels. So now there's not so much of an increase at a decreasing rate. It's, well, how long will that curve remain before we get to that terminal rate, the turning point? Again, I think that the key here, in my estimate, is the median inflation, and that might show signs of moderation. If it does, I think we can start looking and talking about, we can start looking for and discussing a pivot. But before we see that, it's premature, in my opinion. So, and we've said that before. Yeah. Hey Anna, good morning. Nice to have you on the webinar. Meanwhile, Wall Street managers looking to pile into treasuries after months of losses will have to contend with a Fed that stands ready to raise the stakes every step of the way. All right, let's come back to that. Just remember the bond market. I think we should talk about the bond market after we've gone through the Bloomberg email. All right, so the Bank of England is expected to deliver its biggest interest rate increase in 33 years, stepping up an effort to rein in double-digit inflation. The UK Central Bank delivered its decisions at 12 p.m. London time, with Governor Andrew Bailey leading a press conference a half hour later. Officials will publish their outlook for the economy and inflation, likely confirming a long recession is now underway. A 75 basis point increase is the key rate. The key rate is almost fully priced by the money markets. Upheaval in the government has clouded the policy-making landscape for Bailey and his colleagues. Next headline, Germany and China. Germany says cooperation with China where it is in the interests of both sides, but will not ignore controversies, according to the country's Chancellor, Olaf Scholz. We do not want decoupling from China, Scholz wrote in a guest article for Frankfurter Allgemein. Scholz will travel to Beijing on Friday to meet with Xi Jinping amid concerns about European dependency on Chinese products. Berlin is working to hone a new national strategy on China that intends to ensure less reliance diversify supply chains and enhance security. But the trip is a balancing act to discuss business interests and human rights violations. The Biden administration, meanwhile, is warning Germany and other European nations not to let China take control of companies in strategic sectors. I'm going to skip over Twitter. It's no longer listed, so let's just skip that. All right, coming up, European stocks are on course to follow their Asian and US counterparts lower as traders assess the Fed's outlook following another 75 basis point hike. There's more central bank action to digest as the BOE is expected to hike. And ECB President Lagarde speaks at an event. G7 foreign ministers meet in Germany with Russia's invasion of Ukraine sure to be among the biggest topics. Data from Switzerland at CPI is due. It's actually it came in lower than expected. Earnings continues with BNP Paribas, BMW, and Amgen. All right. Let's take a look at some charts and see if there are any potential opportunities here. Let's actually get rid of the dollar for now. I'm going to make this a weekly. And let's throw in that RSI. All right. I think I actually can turn on the camera here. If I can. Yeah, it's coming on. All right, good. I'll keep the camera on here. Let's take a look at the RSI here. Okay, and I think this is a big deal here. It's normalized. So one of the key sort of hypotheses for Q4 was that the real rate is overbought. In other words, the likelihood of normalization shouldn't discount it. And well, it normalized. And that normalization has now, well, we're now in, let's say we are in territory now that lays a platform for higher rates. The technical corrections has potentially run its course. So if we throw in, let's put in the US 30 underneath. Okay. And let's take a look what's happened to the US 30 since we were overbought, right? So yeah. So when the RSI started normalizing, well, here's the US 30 taking advantage of that. Okay. Now the real rate didn't pull back; it just stopped moving up, just started moving sideways. Okay, let's throw in another one. Let's throw in the Nasdaq. Nasdaq actually is underperformed here, which is surprising on a time value of money scale, but not surprising because the earnings have been so lousy coming out of the tech sector. So let's just bring that up. Okay, so you can see that the tech sector did move up, but is now, I think, potentially run its course. It's potentially run its course because the earnings are out, and we've had the normalization in the real rate. Now this puts the risk markets, I think, in a very vulnerable position. So we've got to be very careful here. Let's just show the FANG basket as well. I'll take it out. I know that we're getting a lot of charts here. Let's just put in the FANG. Okay, so this is FX's FANG basket, and you can just see how the FANG stocks have been absolutely hammered. So and that's why there's been an underperformance in the Nasdaq, despite the pullback in the real rate. Well, when I was thinking of a potential bounce for Q4, well, I was thinking Nasdaq would probably be a beneficiary, but the results, that the numerator part of the time value of money, that's hammered it. So it's the US 30 that has benefited. Let's take out the Nasdaq. Let's put in the S&P 500. I've got two monitors, so if I'm not looking directly at you, I apologize. Let's just bring in the SPX. A much better performer than Nasdaq. Okay, but it's generally been the blue chip sort of value US 30 that has benefited the most. I think that makes sense. Okay. So the overbought condition now is normalized. Let's get rid of that. That puts us in a completely new paradigm. Let's go back to the daily. And let's throw in dollar here. All right. Now, real rate moving up, dollar moving up, real rate moving sideways. Let's just bring it to there. Dollar moving sideways. Let's just bring it to there. And now, this is where we're at. Beg your pardon. This is where we're at. Okay, what's going to happen here? So the indication is for a higher terminal rate. If there's a higher terminal rate, I think there is a bias for higher rates. And if that's the case, we're going to carry on using the correlations here. So let's bring in a correlation coefficient. Okay, and you can see that the correlation here, 68%. If this question mark is actually not really a question mark, if there is a movement up here, well, dollar benefits. Okay, if dollar benefits, that means the majors against the dollar are going to face headwinds. It also means that the risk markets are going to face headwinds, and that's where we are today. Bear in mind tomorrow, oh, one more thing. Tomorrow we've got the live trade. It's non-farm payroll. I'm going to just I pasted the link in chat. So you can go ahead and register for that. That's the live trade tomorrow. But that's also going to be, I think, an important factor. All right. Now, we're going to go to market scope in a moment. Before we go to market scope, I think everyone sort of sees correlation here. Real rates really are the driver. That's rippling through to the dollar, and then it just is flowing out. Okay, so let's just do one more chart, which we looked at yesterday. And it's the US median CPI, right? This must go on a monthly scale. I want to actually show you one more thing, and then we'll go to market scope. One more thing that's very, very interesting. All right, cool. So you can see this is the bugbear. You know, until this rolls over, the Fed's really got a fight on their hand, and they have to, You know, they have to front up. You know, they have to fight the fight. So there's not going to be a pivot, I don't think, until this is the sticky inflation. So we can look at core CPR, we can look at core PCE, fine. Whatever progress is made on the core numbers, that's low-hanging fruit. That's the stuff that is reacting to the interest rates. We've got to see the median start reacting and coming down, and that will make you know, things a lot easier on the Fed. What did I want to show you? I want to show you, this is fascinating. All right, let's just bring in M2 money. Just bear with me, and then we're going to go look at some charts if we can find some trading opportunities. But let's just bring in M2 money. Can't remember which one we used. Let's try the first one. Okay, that's fine. That's fine. All right. What I'm going to do now is I'm going to bring in a rate of change. So when we're looking at an annualized CPR, we're looking at today's number versus 12 months ago. Let's do the same thing with money, with the M2 money supply, right? So let's bring in a rate of change. Okay, let's make sure it's 12 months. Okay, I'm going to get rid of, just taking a look at the rate of change. Okay, so this is a rate of change. You know what else is a rate of change? Inflation. So let's bring in core inflation, put it underneath. Okay, so this is a really important cause and effect. What's effectively happening here? The rate of change for money kicks up in that quantitative easing. So this is sort of locked down. Then there's a lag. You know, as the money gets printed and pushed out, there's a lag. Eventually, it hits the economy. It starts being used in the economy, and then it generates inflation. So there's about, sort of, call it a 9-month lag here, sort of between there and there, right? So if there's a 9-month lag, the question is, well, we can see that the rate of change has really come down for money supply. The theory is, of course, that should reflect. It should reflect in the inflation. It should bring the inflation because of that lag. This is again the bugbear, the median. Let's go to the median. Okay, so every time the money supply has dropped off in the past, every time it's dropped off in the past, the median is responding. See that? The median's responding. Drop here, median responds. So that's why it's important for the median to respond. Okay, so this is the issue right here, and I think this is just such an interesting way of looking at it, in that the slowdown in the money supply, and we've still got this sticky inflation. I think the Fed is actually terrified. So talking about a pivot, it's not going to happen until this starts moderating. See, there's just no giving that stickiness at the moment. It's a big deal. All right, let's take a look at some charts. All right, taking a look at the DAX. Okay, so we said yesterday that we are running into this resistance area right at a time when there's going to be a monetary policy meeting, and that's probably going to sort of embolden the resistance, and it has. So we want to keep an eye on what's happening on the daily chart. It's still in zone 1, and the stochastic is still of 80. How this ends today is going to be super important. Is it going to slip from zone 1 into zone 2? My feeling is that's sort of the path of least resistance, so to speak. I think that there is a distinct shift now in sentiment. I think with the real rate normalizing, there's not much out there that you can rely on except the data. You need that inflation data, that median, to show moderation. So without that, I think the risk of actually slipping into zone 2 is a real risk. So if we come down here, you can see that the weakness is the signal was given yesterday. Okay, so the crossover. There has been some sort of stabilization here. The longer that the stochastic stays under 20, the more pressure on the DAX. And I would suggest that central pivot and R1 levels will actually be very strong resistance levels. And I think those are going to be targeted by shorts if we even get there, simply because of the rate environment. In fact, I was taking a look at Euro this morning. Euro had already started slipping. Let's just bring that up. Yeah, you can see that it's just had a really rough start to the day. Let's just zoom into this area here. Sorry, on this. Yeah, that's better. Okay, so this is a weekly chart. Now, this is going to be a very interesting to the week. If we close below last week's low, we've got the bearish reference candle locked in. Okay, so I don't know if we're going to do that or not, but I would suggest that there is a strong possibility. In other words, this could be the lower peak. Could be the lower peak. Okay, and then if that's the lower peak, it sets up for the next lower trough. In other words, drop down to 0.95, possible. I'm not sure, but if we lock in this reference trough, I think it would be on traders' radars, because that's the next round number, isn't it? So this is all looking quite weak all of a sudden. And what we can do is we can just combine this candle and this candle just to get an idea of the sentiment. Okay, so let's just combine these two candles. So what we're going to do is we're going to take this candle's high, we're going to take this candle's low. I'm actually going to just change this to red. And then what we're going to do is we're going to take the open, which is here. This is the open. Here's the close, right? Here's the open. Here's the close. It's not closed for. This is an active candle, so it's not the actual close for the week, but with current close. So we're going to put in the rectangle like this. Okay. What kind of candle is that? That's a bearish candle. This is a what would we call this? An inverted hammer. In other words, we've got an open, bulls pushing up all the way to the high, subsequently losing control, and now they've just been completely savaged by euro bears, and so the sentiment, complete loss of control by bulls. Let's just take a look at the sentiment on the US dollar. Okay, so what we're going to do is we're going to combine this candle and this candle. Okay, so what we're going to do is we'll take the range, which is actually last week's. This is an inside candle, so it's actually last week's high and last week's low. Okay, right. Let's just make this blue, and then let's put in the. So where's the open? The open's here. Where's the close? The close is here. Okay. Just about there. And we can just make this blue. And you can see the sentiment here is, well, this is a hammer, right? In other words, the bears try to push price all the way down. They made it to the low, lost control, and the bulls are just now ripping them apart. So certainly bullish strength seems to be obvious when we combine the two candles, and that's now starting to ripple through to the other instruments. Let's just take a look at the daily here. You can see we've moved out of zone 3, we're back into zone 2. Look at the stochastic here. Dollar stochastic starting to move up. Okay, if we reach that 80 level and hold, that's the next swing. Okay, and you can just see how the dollar here is catching a bid. Now, as long as we stay above 80, I think we should overcome R1, but it's all about holding above 80. If we go below 80, well then, you know, one would be looking to see if there is support that comes in and see if we can buy the dip. So it's an interesting day, completely sort of new feel to the market, but I don't think it's surprising. I think that I think it's pretty much what we expected and what we've been talking about in this webinar. The real rate needed to normalize because it was a weekly chart. It was very difficult to time that normalization. That normalization has now taken place, and that's the key point. Let's see what happens with that median inflation. As soon as we see that moderation in median inflation, I think our conversation is going to change. But until that happens, you know, I think we're seeing the market pretty much for what it is. All right. Any comments? Any questions? Just go ahead. I think we can wrap up at this point and have a good day. You guys have my email address. Have a good evening, and we shall chat. We shall chat tomorrow. Thank you, Rob. Thank you very much. Yeah, let's speak tomorrow. See how the markets develop overnight. Cheers, guys.